Hi, welcome to Retiring Well. Folks, we got a great show lined up for you today. I just recently saw an article on the 13 most frequently asked questions that financial advisors are asked. I thought I'd look at those today. Why is getting financial advice a good idea? Let's talk about that. The two stages of investing. There's the stage when you're working and there's the stage when you're not working, right? What about ladybird deeds? What are they? Are they good for you? And finally, I'm going to talk about real return versus average return, so stay tuned.
Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of Northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well, plan to retire well.
Hi, listen, in this segment, I came across this article and it was by money.usnews.com, and it was talking about the 13 frequently most asked questions that financial advisors get. And I thought I'd just take this moment and just look at them, right? See what they're about. A lot of times we talk about these on the show. Number one, how do I retire? People are asking, how do I go from a paycheck basically to, taking income from my savings and Social Security and the like, right? Well, the income planning is going to answer that question for you. Number two, when can I retire, right? Really, it's going to come down to when can you afford to retire, right? Again, getting back to income planning, you're going to have to take those sources of income, what's my income needs, and put a plan together. Number three, how much money do I need to retire? Well, it depends on the lifestyle you're going to live, right? Some people live more frugal than others, and knowing what their needs are and putting that into an income plan accordingly are going to be very important. So again, top three questions are all revolving around income planning, which we can help with. Number four, how much will I spend in retirement? You're looking at your existing spending habits, but then with inflation, is that going to be the same 10 and 20 years down the road? And am I going to have enough money to satisfy that? Number five, should I retire early? Well, you're going to want to run a number of different scenarios, right? Social Security maybe at 62, maybe waiting to age 70. We can do that in income planning, run those different scenarios and see which one works best for you. Number six, when should I take Social Security? Big question, right? If you take it at 62, but if I wait to age 70, it's almost double. Can I do that, right? Can I afford to do that? How about surviving spouse? She gets the greater of the two surviving benefits. What's that look like? Number seven, how do I apply for Social Security? Well, you can go online, ssa.gov, or you can set an appointment with the local office and apply that way. Number eight, how much will I pay in taxes? Big question. This is where tax planning comes into place. You've got your qualified accounts that are going to be taxable now. Those are your IRAs and 401ks because no tax has been paid. Roth IRAs not. Maybe Social Security, depending on how much income you have. Maybe a tax plan would be appropriate. Number nine, pension lump sum or annuity. Which one do I take? Folks, that's something that we're going to have to sit down and actually calculate. We're going to look at the payout percentage, which is the credit quality of the company that's paying the pension. Number 10, how do I afford medical expenses in retirement? Am I going to have to be on the marketplace? Can I afford it? What about Medicare? Do I want a Medicare supplemental insurance policy? Number 11, how should my money be invested in retirement? Folks, you're going to want it protected and you're going to want to have it keep up with inflation for sure. Number 12, what will I do in retirement? Well, you want to have specific goals. Am I going to have a hobby I'm going to pour my life into? Is it volunteer work? Maybe it's part-time work. You're not just going to jump into retirement and do anything. Number 13, should I pay off my mortgage? Obviously, having no debt in retirement is the ideal, but who could argue with low interest rates today and your investments maybe being able to make more, that there's some room for having maybe a mortgage so you could qualify for those itemized deductions and get over that standard deduction. So folks, if you get anything out of this, when I'm looking at all these questions, they're all involving income planning, investment management, tax planning, all things we can help you with. So give us a call.
Your grandchildren are precious to you. They are your life. This is your time to have that special relationship. Taking care of yourself is taking care of them. Centennial Wealth Advisory is offering a free, no-obligation retirement review to make sure you don't run out of money during your retirement. Centennial Wealth Advisory. Your best is yet to come.
Hi, in this segment, I want to talk to you about why getting financial advice is a good idea. All right? Now, first of all, let me just say this. You don't know what you don't know. All right? You may think you have a lot of knowledge in this area, but there's things you don't know, and maybe having a financial advisor involved with you as kind of a team member can help you with those things, right? The other thing that stands out is experience matters. If I'm doing stuff around my house, whether it's maybe tiling my floor or maybe it's doing some electrical, if I don't have a lot of experience in that area, I'm going to hire somebody that knows how to do that, right? No different in the financial service industry. Bring somebody along that's got the experience, that's been around a while, knows what they're doing. The other thing is, I think of those how-to videos, right? I've been renovating an RV, and I one day I had to go in, I had to pull this couch out. I couldn't quite see, how it was going to happen. I watched this video, how-to video on YouTube, and lo and behold, I watched it for about 3-4 minutes, went in and knocked it right out because I could visually see what they were doing. It's the same thing when you're trying to get financial advice out there, right? It really helps when they can put things forth to you that make it real simple, real easy to understand because, again, they have the experience, they have the knowledge. It's even best if you really actually even know what you're doing to get a second pair of eyes. Right? I may be kind of trucking along, knowing what I'm doing, feeling really good about what I'm doing, but why wouldn't I want to get a second opinion? Why wouldn't I have somebody come alongside me and say, hey, have you ever thought about maybe, doing this? Getting a financial advice can help you avoid those emotional decisions, right? Sometimes we get our emotions caught up in our investing. Maybe we've got emotional attachment to a stock and maybe we want to ride it down too far, and maybe the idea is, really to look at something else and do something differently. Having somebody come alongside us and help us with that decision is very helpful. Folks, there is numerous financial instruments out there, and knowing the pros and cons of them is very, very important. And you want to talk to you want to get some financial advice and have that advisor sit down and say, okay, here's this financial instrument, good, bad. Here's another one, good, bad. And then once you have that knowledge, you can make a good decision for yourself as to what instrument might meet your goals and objectives better. And then there's a myriad of issues out there. You've got estate planning, tax planning, income planning. You've got all these different aspects that you're going to be dealing with in retirement. And again, having somebody with experience is very helpful. Folks, at the end of the day, it's a value proposition. Is the advice I'm getting, is it going to outweigh the cost of that advice? That's going to be the answer at the end of the day. So hopefully maybe we can help with that. If we can, give us a call. We'd be glad to talk to you about it.
A lot of good information there shared by Larry, and it's so true. There are so many questions out there, and having been in the financial services industry for over 15 years now, I see that there's no dumb questions. There's all good questions and a lot of information to learn, and it's so important to get sound financial advice. Now, Nick here is in our Gaylord office right there on Main Street, and has had a couple of recent cases where you said this would fit in well with getting sound financial advice.
Yeah, absolutely. And you know what I found? A lot of people, they think they have a good plan. And when they come down and sit down here in the Gaylord office and they go over everything with me, things come to light. Mm-hmm. They really do. And I had a recent case where a couple thought that the best idea for them to minimize their income for health insurance was to start drawing down from their Roth accounts. And typically what we recommend is those are the last accounts you really want to touch because they're tax-free. Yes, they don't show that income, but we all know taxes are only going to go up in the future. So it was a little bit of a tough break for them. They didn't like to see that or hear that. But it made sense, and they changed their plan pretty quickly.
Sure. Oh yeah. No, that's tax planning is so important when it comes to mapping out your income plan and how it impacts your health insurance. And then, Nick, you said there was another case where you were working through and some different ideas came up that they weren't quite sure about.
Yeah, so this couple had quite a substantial amount of money just sitting in cash, and they wanted to purchase a house. Well, some way or another, they were told that they should take out a mortgage instead of using that cash that was not making any money for them. And
yeah, especially in such a low interest rate environment. I mean, right now is probably not the time if you have that sitting there. Instead of taking out a mortgage and paying interest, maybe it's better off just use that cash.
Absolutely,
so yeah, there's a lot of different areas that that are important to look at when it comes to your retirement planning, and our job is to help you plan to retire well. So stay tuned. We're coming up is the 2 stages of investing.
are you nearing retirement or in retirement? Have you had your portfolio just looked at or have a second opinion on that portfolio recently? Centennial Wealth is a full-service advisory firm, and we have multiple locations in northern Michigan. I'm in the Gaylord office primarily. The office is right downtown Gaylord. Also up in the Petoskey office as well. That office is right off of 31. I'd love to hear your story. I'd love to sit down and chat, and it's a free, no-obligation consultation, so just call the number on the screen.
Hi, welcome back. Listen, in this segment, I want to talk to you about the 2 stages of investing. When you're in your working years, you're getting a paycheck, hopefully you're meeting your income needs. What you want to start doing is setting some monies aside for retirement. Okay, we call this the growth and accumulation phase of our lives, or the stage of our lives, because we're trying to save. We're trying to save for that great day when we can finally not have to work any longer. Okay. But when we get near retirement, or we're soon to be retired, you know, we're entering a different stage. And it's very important to understand this, because we're now entering what's called a preservation of wealth and income phase of our life. It's a whole different stage, because we're rapidly getting to that place where we're not working any longer, or not going to be working. We can't grow and accumulate assets anymore. We're going to have to rely on that nest egg for an income. So what's my attitude or risk tolerance now at this time? When I was in the growth and accumulation phase of my life, if my account dropped quite considerably in any one year, doesn't really have too much of an effect on my life, because I have that paycheck, I have that income coming in, my needs are being met, and I have time for that asset to come back to where it was and possibly again grow. But if I'm getting close to retirement, I'm soon going to get there, and I have to rely on that savings to now be income for me. Can I afford to have that account drop significantly? Do I have the time to be able to wait and have that come back? I might not. And folks, if I'm actually in retirement and I no longer have any other income but that portfolio, maybe Social Security, then it's going to have a drastic effect on my lifestyle. So understanding this stage and what stage I'm in is going to be very important, because how I invest appropriately is going to be different under both those scenarios. So why are we having this conversation? We see too many times where people are coming in, they're getting near retirement, or they're in retirement, and they're invested exactly like they were maybe in the growth and accumulation phase of their life. Very, very dangerous, because if in that previous stage that they were in, they were taking a lot of risk, and now they're bringing that into this next stage, again, what are they going to do if the market drops dramatically and that income plan gets blown apart? So very, very important to speak to an advisor. We encourage you, give us a call to make sure that whatever stage you're in, you're invested appropriately. So give us a call.
Through the school programs in our local school district, kids receive physical therapy to work on their mobility skills, occupational therapy to work on their fine motor and handwriting skills, as well as speech therapy to work on their communication skills. And during the summer months, there's limited school therapy available, and the children are selected based on their severity of need. Kids on the Go is the first of its kind in the entire Northern Michigan region, and we're excited to expand our healthcare resources. Kids on the Go is 100% donation-based, and 100% of the funding received for our Traverse City program goes towards supporting local children. And our program is run by local physical therapists, speech therapists, and occupational therapists in our region, and it's based in a local school right here in Traverse City. We're just beginning our journey with Kids on the Go, but I have big dreams for this program. Well, we're very excited for any support from our local community, and we're thrilled to already have received a lot of generous support from different businesses and individuals in our community that have embraced our program. Kids on the Go has a website, and that's www.kidsonthegocamptc.com. And all camp information and donations can be made through our website. Our camp registration opens January of each year online, and you can simply go to our website and log in there to register, or feel free to email myself or one of the other therapists if you have any specific questions about our programming. As a small and new nonprofit, we were able to pivot and move our services to an online platform where we were able to provide fun and safe therapy to a group of local children. I feel that it was really well received. I had a lot of positive comments from families that really enjoyed working together as a group from a virtual platform. And it also gave our therapists the tools to be able to work together and plan programming that we'll be able to build off of in future years.
Lady Bird deeds, what are they? Now, I think the term comes from Lady Bird Johnson, is it, from what I understand. But what are they? Most of your investments, most of your, like your savings account, checking accounts, maybe your investment accounts, you have the ability to set beneficiary designations on those. When you die, they know where to go because you've listed a primary beneficiary. And then in case that primary beneficiary isn't around, you've listed contingent beneficiaries. So this goes in any good estate plan, because what you want in a good estate plan is having all your assets knowing where to go. Now there's one asset you have, though, for the most part doesn't know where to go unless you put it in what's called a Lady Bird deed. That's your home. All right? If you were to leave this earth today, would your home know where to go? Most likely not. So it's going to have to go through probate, and then your will is going to have to determine who that home goes to. But here's what you get to do. If you put your house in what's called a Lady Bird deed, now it doesn't change your incident of ownership, it doesn't change your use of the property in any way. It just simply puts a beneficiary designation on the deed that says, when you die, here's where it goes. Now, and it completely avoids probate. Now, it's a good planning tool when you're looking to, let's say, maybe avoid Medicaid or the state or federal government taking it. Think about it. If you have a house, they tell you they can't take your house to pay for your care if it's the government paying for your care, okay? But if they let you keep your house, but when you pass away, now they can come back after it, all right? Now, the way most people used to try to protect it is they try to put it into a trust. But now they say for Medicaid planning, you can't even apply for Medicaid until that house is taken out of a trust. Why did they do that? They did that because they want to be able to attach it, so they don't want you to have it in a trust. But here's the beauty. If you put it in a Lady Bird deed, what happens is it never goes through probate. Remember that. So when you pass away, it goes to the beneficiary, avoids probate, state or federal government can't touch it. So it's a great, what we call elder law planning tool that you're going to see a lot of attorneys want to use. Now, you can also make the beneficiary of the Lady Bird deed the trust. So if you indeed, for one reason or another, wanted it to go to the trust, well then just list the trust as the beneficiary in that Lady Bird deed. Then when you pass away, avoids probate, goes into the trust, then gets distributed according to the trust and how you had it. So folks, this is a great estate planning tool. Listen, if you have a lot of assets and they all know where to go, for the exception of your house, and you want to avoid probate there too, then I suggest you learn more about a Lady Bird deed. Give us a call. We'd be glad to direct you in the right direction.
Well, thank you for that, Larry. That was a lot of great information. Speaking of estate planning and kind of diving into that world, I found that a lot of people they hear trust and they think they might need a trust, but is that really the case?
Right, yeah, good question, Nick. So often people are looking at estate planning and as instantly they think of, well, I need a will or I need a trust or whatever it might be. You know, Larry was talking there about Lady Bird deeds and essentially how with your real estate you can name the beneficiary structure attached to that, and often with different bank accounts you can have POD, payable on death, or TOD, transferable on death, or different brokerage accounts. You can have named beneficiaries as well as IRAs, life insurance, all of that. But it is one where you do want to look at estate planning. And again, we're not estate planning attorneys, but we work closely with them or can bring them in to assist you when you're looking to set up that plan to retire well. I was recently sitting down with a woman here in Traverse City who had recently lost her husband, and it was prior to them retiring, and so we were talking through just sort of how to handle the transition of assets from his accounts over to her, and now that there was some life insurance, so there was some tax-free money, so we had to evaluate the tax side of things, but then started diving into the estate side and still had children, and it was a situation where didn't want to see those kids as we can imagine, Nick, of you don't want to see them potentially, if something were to happen to her, to them get a lump sum at a very young age. And so we started talking through that and bringing in the estate planning attorney to try and map out ultimately what that might look like, and potentially having some type of will or trust in place to help establish some type of long-term plan, not only for her but for her family.
Awesome. Thank you for that, John. Coming up next, Larry's going to talk about real return versus actual return.
We look forward to helping you plan to retire well.
Hi, welcome back. Listen, in this segment, I want to talk to you about real return versus average rate of return. Two different things. So let me illustrate. Let's say you had an investment or portfolio that made or lost 50% the first year. Okay, it made 50% the second year. It lost again 50% the third year, and then again made 50% in the fourth year. Wouldn't you say that's a pretty volatile investment? Funny thing though, if you do the math on that investment, they would tell you that that portfolio or that investment averaged 0%. All right, but what if I had $100,000, okay, and the first year it lost 50%. That means now my investment is down to $50,000, okay? Then in the second year it made 50%. Now I'm back up to $75,000. All right, then it loses 50%. Now it's down to $37,500. And then lo and behold, the fourth year it's back up 50%. Now I'm at $56,250. Now, for an account that averaged 0%, this portfolio really lost 43.75%. Now, that's a big difference. And if you look at out there, most portfolios or investments, what is the return they're always trying to give you? Most generally, they're going to give you the average return. But the real return is much, much different. Now, I recognize that this is an example that's grossly exaggerated, because how many investments do you see losing 50% and gaining 50% year after year is? But very vitally important to understand the difference between the two different numbers, between real and average, because if I'm looking at my investments and I'm just looking at the average and it has a high degree of volatility to it, then what is really my real rate of return? Very, very important to understand, very important to know. If you're somebody that wants to know the volatility of your portfolio, most importantly, how it operated in 2008 in the last recession, so you can see what kind of volatility it could possibly have, then you're going to want to give us a call.
Really good information from Larry there about real return versus average return, which is really important when it comes to your retirement planning. But just as important as that is coming up with a long-term income strategy. If you're approaching retirement or in retirement, you've got to be mapping out, what does this look like over the next, not just 10 years, but 20 or maybe even 30 years. And so factoring into that, what inflation looks like for you, and maybe if you're currently spending, say, $4,000 a month, what does that really add up to over that length of time? So that way when you're in your late 70s, early 80s, you're not sitting there thinking, uh-oh, I didn't plan for this. But just as important as income planning is then coming to your investments and risk, and how big of a role that plays, Nick.
Yeah, absolutely. Risk is a huge factor when we're talking about retirement planning. Between the couples, you find that they have a varying risk tolerance, and that's okay, but that's something we need to determine. And another thing that we find very interesting is how people sometimes assume there's a certain amount of risk that they're actually taking, when in reality we find that, like they saw back in March, they lost way more money than they thought they ever should. So that's one of our big jobs, is to try to figure out what your risk tolerance really is.
And that's where it's nice. We have the tools available to basically look at your current portfolio and better understand sort of what that maximum drawdown might be, to see, hey, how would you have reacted, for example, like Nick referenced there, last year in March when the market dropped so quickly? How would your portfolio have responded to that? And what are maybe some different ways or different tools that are available to try and help you mitigate some of that risk? And along with that, we also look at tax planning. And when you're especially factoring in a long-term income plan, we've got to make sure that we're factoring in how taxes play a role, and then along with that, then what impact is that going to have if you're currently under age 65 and needing health insurance? There's different ways that we have to consider how to structure your portfolio to generate that income to potentially help you in getting subsidies for that health insurance planning. And last but not least, obviously, is the estate planning side that we referenced earlier in the show. So vital when you're trying to come up with a big picture, full retirement plan. And that's our job here at Centennial Wealth, is to help you plan to retire well. So if you're looking for more information, Nick's available in our Gaylord and Petoskey office. Myself, I'm here in Traverse City, and we have Jack and Cadillac, and we'd love the opportunity to sit down with you for a no-cost, no-obligation visit to help you plan to retire well. Thanks again for tuning in.